Hi friends, welcome back. We are continuing our discussion on ratio analysis. If you have not watched the ratio analysis part 1, please go through that before proceeding this one. We will start with the problem. The capital structure of Hop Limited is as follows. Equity share capital of rupees 10 each, 8 lakhs. 9% preference share capital of rupees 10 each, 3 lakhs. Total 11 lakhs. Additional information. Profit after tax at 35% rupees 2 lakhs 70,000. Depreciation rupees 60,000. Equity dividend paid at 20%. Market price of equity share rupees 40. You are required to compute the following, showing the necessary workings. A. Dividend yield on equity shares. B. Cover for the preference and equity dividends. C. Earnings per share. D. Price earnings ratio. We will start with the first one, dividend yield. Yield is the income retained on investment. Here, the income is the dividend on share and the investment is the amount paid for the share. Dividend is given as 20% and the face value is 10%, 10 rupees. So, the dividend is 2 rupees. And the amount paid for the share is 40 as the market value of the share is 40. Substituting these two figures, we will get 2 divided by 40, that is 5%. Dividend coverage ratio means the number of times the amount available for paying the dividend. If the number of times is more, the preference shareholders are in a better position. That is the significance of this ratio. So the amount available is to be divided by the preference dividend or equity share as the case may be. Preference dividend coverage ratio is equal to profit after taxes divided by dividend payable to preference shareholders, because profit after taxes is the amount available to the preference shareholders for making their payment. Profit after taxes is given as 2,70,000 rupees and the preference dividend we can calculate 9% of 3 lakh, that is 27,000. Substituting these two values, we will get 2,70,000 divided by 27,000 is equal to 10 times. Equity dividend coverage ratio is equal to amount available for equity dividend payment divided by dividend payable. So, the formula works out to be profit after tax minus preference share dividend. That is the amount available for paying dividend to the equity shareholders. So, that divided by the amount to be paid to the equity shareholders. So, amount available divided by amount payable. That is the coverage ratio. Profit after tax is 2,70,000 and preference share dividend is 27,000 we know. Dividend payable to the equity shareholders is 8 lakh into 20% because 20% is the dividend rate. So 2,43,000 divided by 1,60,000 is equal to 1.52 times. Earnings per share, as the name indicates, it is the earnings available to each shareholder. So we have to divide the total earnings divided by number of shares. Total earnings is 2,43,000 and number of shares is 8 lakh divided by 10, 80,000. 2,43,000 divided by 80,000 is equal to 3.04 per share. That is the EPS or earnings per share. Price earnings ratio. Price means market price of per share. Earnings means earnings per share. So we know both. Market price is 40 and earnings per share is 3.04. By substituting, we will get 40 divided by 3.04, that is 13.2 times. We will summarize the ratio we studied in this problem. Dividend yield ratio. Yield means the return on investment. Dividend per share divided by market price per share. Dividend is the return and market price is our investment. So, dividend price divided by market price per share will give you dividend yield. Dividend coverage ratio preference. Amount available for preference shareholders divided by dividend payable to the preference shareholders. So, what is the amount available for paying the dividend, or how many times the amount available in comparison to the amount really payable? That is the preference coverage ratio and equity coverage ratio also. So, when equity coverage ratio comes, what is the amount available to the equity shareholders divided by dividend payable? Earnings per share, as the name indicates, it is earnings available to the equity shareholders divided by number of equity shareholders. Price earnings ratio. Price is market price and earnings is earnings per share. Market price divided by earnings per share will give you price earnings ratio or P by E. This is one of the most important ratio while we come to the investing in shares, because this ratio reveals in how many years the share will make the amount we invested. So if the P by E is less, it is an advantage. Financial analysis horizontal. When financial statement of one year is analyzed and interpreted after comparing with another year or years, it is known as horizontal analysis. Vertical analysis is a method of financial statement analysis confined to a single year in which each item is stated as a percentage of a base figure within the statement. Thus, items of an income statement can be stated as a percentage of sales, while items of a balance sheet can be stated as a percentage of total assets or liabilities. And cash flow statement shows each cash flow as a percentage of the total cash inflows. Let us start our next problem. Following information relate to a firm. Debtors velocity 3 months, creditors velocity 2 months, stock turnover ratio 1.5, gross profit ratio 25%, bills receivable 25,000, bills payable 10,000, gross profit 4 lakhs, fixed asset turnover ratio 4, closing stock is 10,000 above the opening stock. Find out sales and cost of goods sold, sundry debtors, sundry creditors, closing stock, and fixed assets. Going through the problem, we can see that gross profit is given as well as the gross profit ratio is given. So from these two information, we can find out the sales, gross profit, and cost of goods sold. Gross profit ratio is equal to gross profit divided by sales into 100. 25 is equal to 4 lakh divided by sales into 100. By substituting, we will get sales is equal to 4 lakh by 25 into 100, that is 16 lakh. Cost of goods sold is equal to sales minus gross profit. 16 lakh minus 4 lakh is equal to 12 lakhs. Debtors velocity is given as 3 months. That means debtors will be collected after 3 months from the date of sale. So the last 3 months sale is outstanding. So we can find out the debtors by multiplying the sales into 3 divided by total number of months, that is 12. 16 lakh into 3 divided by 12, that is 4 lakh. So the total debtors is 4 lakhs, but the bills receivable rupees 25,000 is part of the debtors. So the sundry debtors is 4 lakh minus 25,000, that is 3 lakh 75,000 only. Now we need to find out the closing stock. To find out the closing stock, we can use the formula of stock turnover ratio. Stock turnover ratio is equal to cost of goods sold divided by average stock. Stock turnover ratio is given as 1.5 and the cost of goods sold we found out rupees 12 lakhs. From these two figures, we can find out the average stock. Average stock is equal to cost of goods sold divided by stock turnover ratio. 12 lakh divided by 1.5, which is 8 lakhs. Average stock we know is opening stock plus closing stock divided by 2, and the closing stock is given as 10,000 above the opening stock. By substituting these values, 8 lakh is equal to opening stock plus 10,000 divided by 2. In the right hand side, there are two opening stock. Dividing by 2, you will get opening stock, and 10,000 divided by 2, you will get 5,000. So 8 lakh is equal to opening stock plus 5,000. So the opening stock works out to be 8 lakh minus 5,000, that is 7 lakh 95,000. So the difference is 10,000 between opening stock and closing stock. So closing stock is equal to opening stock plus 10,000, that is 8 lakh 5,000. Now we need to find out the creditors. Creditors velocity is given us 2 months. But to find out the creditors, we need to know what is the purchase for the year. Purchase can be found out from the formula opening stock plus purchase is equal to cost of goods sold plus closing stock. By substituting the known figures, opening stock is 7,95,000 plus purchase is equal to cost of goods sold 12 lakh plus closing stock 8 lakh 5,000. Purchase 12 lakh plus 8 lakh 5,000 minus 7,95,000 is equal to 12 lakh 10,000. Creditors velocity is given as 2 months, and now we found out the purchase as 12 lakh 10,000. So we can find out the creditors. Creditors velocity 2 means the last 2 months purchase amount has not been paid. So we need to find out what is the purchase for the 2 months. 2 months purchase can be found out by multiplying the purchase by 2 and dividing by 12. That is 12 lakh 10,000 into 2 divided by 12. The total creditors is 2 lakh 1,667. Now we have given the bills payable is 10,000. So the total payable includes this 10,000 also. So the creditors, the central creditors will works out to be 2,01,667 minus 10,000, that is 1,91,667. Now we need to find out the fixed asset. Fixed asset turnover ratio is given as 4. So 4 is equal to sales divided by fixed assets. Fixed asset is equal to sales by 4, that is 16 lakh divided by 4, and the fixed asset works out to be 4 lakhs. Let us have a quick recap of the formulas and ratios we studied in this problem. Gross profit ratio is equal to gross profit divided by sales. Sales is equal to cost of goods sold plus gross profit. Debtors velocity is equal to debtors divided by sales. If you multiply by 12, you will get it in months, and if you multiply by 365, you will get it in days. Likewise, creditors velocity is equal to creditors divided by purchase. If you multiply by 12, you will get it in months, and if you multiply by 365, you will get it in days. If the sales and debtors velocity is given, we can find out the debtors. Debtors is equal to sales into debtors velocity divided by 12 or 365, as the case may be. If the debtors velocity is given in months, you have to divide by 12, and if it is given in days, you have to divide by 365. Same logic applies for creditors. Creditors is equal to purchase into creditors velocity. Lastly, two turnover ratios we dealt in this problem. Stock turnover ratio is equal to cost of goods sold divided by average stock. All other turnover ratios except stock, we are dividing the turnover by that ratio. Turnover means sales. So only stock we are dividing the cost of goods sold, as we explained earlier in one problem, because of the matching concept, because average stock is taking the cost price, so we are taking the cost of goods sold. On all other turnover ratio, we are dividing sales by that particular item. Now we will discuss the application and advantage of ratio analysis. First one, the indication of liquidity position. Ratio analysis helps to assess the liquidity position, that is the short-term debt paying ability of a firm. Liquidity ratios indicate the ability of the firm to pay and help in credit analysis by banks, creditors, and other suppliers of short-term loans. 2. Indication of long-term solvency position. Ratio analysis is also used to assess the long-term debt-paying capacity of a firm. Long-term solvency position of a borrower is a prime concern for the long-term creditors, security analyst, and the present and potential owners of a business. It is measured by the leverage or capital structure and profitability ratios, which indicate the earning power and operating efficiency. 3. Measurement of operating efficiency. Ratio analysis indicates the degree of efficiency in the management and utilization of its assets. Different activity ratios indicate the operational efficiency. 4. Indication of overall profitability. The management is concerned with the overall profitability of the firm. They want to know whether the firm has the ability to meet its short-term as well as the long-term obligations to its creditors, to ensure a reasonable return to its owners, and secure optimum utilization of the assets of the firm. 5. Interfirm comparison. Comparison of performance of two or more firms reveals the efficient and inefficient firms, thereby enabling the inefficient firms to adopt suitable measures for improving their efficiency. 6. Budgeting. Budget is an estimate of future activities on the basis of past experience. Accounting ratios help to estimate the budgeted figures. 7. Control of performance and cost. Ratios may also be used for control of performance of the different divisions or departments of an undertaking, as well as control of cost. 8. Detection of unfavorable factors. Analysis of financial statements enables the analyst to find out the soundness or otherwise of a business. If the analysis reveals financial unsoundness, the factors responsible for such unsoundness can be separated and corrective action taken without loss of time. We can conclude by saying absolute figures are dumb, but the ratios have the power to speak. Let us do another problem. From the information given below, calculate the amount of fixed assets and proprietors funds. Ratio of fixed asset to proprietors fund 0.75. Net working capital 6 lakhs. A very small problem. Only proprietors fund, fixed asset, and net working capital is given, and only one ratio is given, and a net working capital absolute figure of 6 lakhs is given. For a understanding of this problem, we need to draw a format of the balance sheet. So the balance sheet contains only few figures: proprietors fund, fixed asset, and current liabilities. Long-term loan we are not taking because it is not mentioned in the problem. Now we need to rearrange the balance sheet. Current liability is deducted from the current asset, and we write it as a net working capital. Net working capital figure is given as 6 lakhs. Ratio of fixed asset to proprietors fund is given as 0.75. That means Fixed asset is equal to 0.75 proprietors fund, or fixed asset is equal to 75% of the proprietors fund. Since the fixed asset is 75% of the proprietors fund, net working capital is 25% of the proprietors fund. So we can find out the proprietors fund 6 lakh divided by 25%, or that is 24 lakhs. Now fixed asset is 75% of the proprietary fund, that is 24 lakhs into 75%, 18 lakhs. Now let us see some limitations of the financial ratios. 1. The problems in accounting. Ratios are based on accounting figures given in the financial statements. However, the accounting figures are themselves subject to deficiencies of approximation, diversity in practice, and manipulation to some extent. To give good shape to the popularly used financial ratios like current ratio, debt equity ratio, the business may make some year-end adjustments. Such window dressing can change the character of financial ratios to mislead the users. There is no standard set of ratios against which a firm's ratio can be compared. It is very difficult to generalize whether a particular ratio is good or bad. For example, a low current ratio may be said bad from the point of view of low liquidity, but a high current ratio may not be good, as this may result from the inefficient working capital management. Financial ratios are interrelated, not independent. Viewed in isolation, one ratio may highlight efficiency, but when considered as a set of ratios, they may speak differently. Financial data are badly distorted by inflation. Historical cost values may be substantially different from the true values. Now we will discuss some important ratios which we have not come across while doing the problems. Capital gearing ratio. It shows the proportion of fixed interest-bearing capital to the funds belonging to the equity shareholders. This is calculated by preference share capital plus debenture plus long-term loans divided by equity share capital plus reserve and surplus minus losses. Debt equity ratio. The most commonly used formula is long-term debt divided by shareholders' equity. But sometimes the long-term debt is replaced by total debt or all the total outside liabilities. Shareholders' equity is equal to equity plus preference share capital plus reserve and surplus. Debt service coverage ratio gives an idea of the firm's ability to pay off current interest and installments. It is a coverage ratio. It gives you how many times the amount available covers the interest and installments. The formula for finding debt service coverage ratio is earnings available for debt service divided by interest plus installments, or the EMI. Interest coverage ratio is equal to earnings before interest and taxes divided by interest. Return on investment is an important ratio as it gives the percentage of return on funds invested in the business by its owners. It can be calculated by return by investment into 100, or return divided by sales into sales divided by investments. So the first ratio is the profitability ratio and the second ratio is the investment ratio. So return on investment is equal to profitability ratio into investment ratio. The concept of investment varies and there are three different ratios under the return on investment, that is return on assets and return on capital employed and return on equity. Return on assets is equal to net profit after tax plus interest divided by average total assets. Here interest is added back because assets are also financed by the lenders. So the return to the lenders is also part of the return. Return on capital employed is equal to EBIT, or earnings before interest and tax, into 1 minus T divided by capital employed. Here the capital employed is taken as total assets minus current liabilities, or fixed assets plus working capital. Return on equity is calculated by net profit after tax minus preference dividend divided by equity shareholders fund, that is amount available to the equity shareholders divided by the fund invested by them. Dividend payout ratio, or DP ratio. Dividend per share divided by earnings per share, that is what percentage of the earnings is distributed as dividend.